This morning. To my immediate left here is Ted Olson. Ted is a serial entrepreneur, an executive leader, principal at NeoWise, and a partner at Blue Ventures. Elaine Haynes is a business builder and president and CEO of Kalicite. Greg Miller is entrepreneur, investor, and co-founder of Health Tech Alley. And Jay Tarakia is regional leader and Greater Baltimore market president at Truist. Welcome.
Thank you.
So why don't we start this morning and just walk us a little bit through your journey and tell us a little bit about yourself, how you got to where you are. And I want to let the audience know that the topic this morning is capital markets. What we want to discuss is access to capital, what it's like accessing capital here in Maryland, here in Baltimore. What challenges do we face? You know, we don't have the investor density that you see in Manhattan or Boston or San Francisco, but we have a lot of very successful companies. And so we'd like to kind of elevate this conversation around capital and accessing capital in the state of Maryland and in Baltimore. So Ted, why don't you start with some introduction about yourself?
Sure, thanks, Marty. So Ted Olson, I'm a serial entrepreneur in the area. I've started 2 biotechs, a lithium-ion battery company out of College Park, and a telecom company that went through an IPO about 20 years ago. The part that I really love is this early stage high-tech environment that is here in Baltimore. It's really strong in the whole mid-Atlantic area. And I guess to me, I look back for the last 15 years in money that we've had to raise for these companies that I've started. And this whole ecosystem has gotten so much stronger and so much better here. It's still not where we need to go, but there's multiple options. There's a number of people that had very successful exits that are interested in paying back, putting money to work in some of the new technologies that are coming up. Now, I'll give you an example of something that was really close and personal. The battery materials company we started a year and a half ago, we had an investor that said, we're in for $150,000, but we want a side letter that we can invest another $500,000. And as we talked through this stuff, if you were in Boston, people would give you a check for $750. If you were in San Francisco, they'd probably give you a check for $1 million. And here, it's just a really different environment, and I like to liken it to the government contracting business and government employees. If things just are a lot more conservative, and you end up with those type of things. So you just have to understand the venture climate and investor sensitivities that you're playing to, because it's really different here, and it's sort of unique. Some people would say in a good way, some people say in a challenging way, but it's just different.
Great. Hi, I'm Elaine Haynes. I'm president and CEO of Kalicite. Kalicite means good cell, and we're on a mission to develop a artificial red blood cell substitute that can be used for when blood's not available. I joined Kalicite about 3-4 years ago now as its first CEO, right after the initial tranche of seed funding. And I came to Kalicite after my first career in pharmaceutical and device commercialization because I really wanted to work with a team that was growing an innovative product that was going to have a major impact on patients. So when I paired up with the founding team at Kalicite, it was just an excellent match. We since moved the company to Baltimore from St. Louis, where we were founded, and have had tremendous support from the University of Maryland, Baltimore, where we're based, and the Maryland Momentum Fund. In fact, half of the $3 million that I've raised since we've been here has either been from Momentum Fund or through connections made via Momentum Fund since we've been here. We are transitioning from seed to Series A. In fact, I'm actively raising our Series A right now. So I do have some comments on how the capital market is now. It's a little tight, but it's really important to find that right fit with what you're doing and what your VCs or our angels are interested in supporting. But it's been a fantastic move for us here, and I've really enjoyed being in the Baltimore area. Thanks.
Thank you. Greg?
Hi, everybody. My name is Greg Miller. I am a co-founder of Health Tech Alley, so it is a startup. It's founded to underserved communities and the organizations that serve them. But I am also an active angel investor, and so I have networks here in the Mid-Atlantic as well as the Upper Midwest. I'm in a couple of different networks, a couple of different syndicates. I also advise a number of startups in both of those locations. And frankly, I just love being a part of this innovation and entrepreneurship community. I have traditionally been a big company corporate guy, American Express, Deloitte Consulting, and Blue Cross Blue Shield. And a few years ago, I kind of flipped it on its head and went very organic to where the source of innovation is. And I love being a part of it.
Great, thank you.
Big company corporate guy. Good morning, everybody. I'm Jay Tarakia. I'm the market president for Truist here in Greater Baltimore. Truist, if you're not familiar with the name, is the merger of SunTrust and BB&T that came together in 2019. We're the 6th largest bank in the country, and perhaps more importantly than that, we're very much a purpose-driven company. And our purpose is to build and inspire better lives and communities. And my job as market president is to deliver on that purpose here in Greater Baltimore for the 835 teammates that we have here locally. So really glad to be here, really appreciate being here. I kind of got started in business, or sparked my interest in business as I grew up in one. My father was a sole practitioner, internal medicine doctor who moved here from India, hung up his own shingle, and just like a really, really strong practitioner, but a terrible business person. He would see patients for 90 minutes at a time. When I go to the doctor today, it's a factory. It's 10 minutes in, 10 minutes out. And he would spend 90 minutes. If they couldn't pay, he'd let him go. And I would come into the business as a 14-year-old kid, just trying to help him out and run his payroll and run the card processing and run equipment. And as I grew up, his expectation of me was to become a doctor, but it's very stereotypical, but as I told him, I've kind of got the itch for business now. So I went on to do that, and if I couldn't be Ted, Elaine, or Greg, the next best thing was being in a position to support them. And that's how I found my way into banking and started my career in small business. So thrilled to be here. Thank you all for being here, and thanks Marty and Pam for the invitation.
Great, thank you. So our panel has raised money, is raising money, has invested money, and is helping companies raise and invest money. Elaine, you mentioned the current climate. So you're out there right now, and you're looking to raise money. So tell us about that current climate. What does it look like?
So right now, first of all, once you've gotten past that, that first initial pitch and established interest, the follow-on conversations, start with, is it the right fit? Have you checked all of the boxes for fit with the investment thesis? But then where we've gotten hung up is in one of two areas. Either one, our stage of development and risk profile doesn't fit with what the investor's looking for, or what I'm hearing more with the investors that we've gotten the farthest is, we love you guys, we want to keep in touch, but right now we need to prop up our portfolio companies. So we're seeing valuations are flat to down, and that the reserves are being devoted towards their portfolio companies as opposed to taking on new investments.
Interesting. Greg, what's the investor's view of the current market?
Yeah, it's interesting. Certainly this is a challenging year, and I would echo the comment. A lot of VCs, private equity companies, and even angel networks are focused on keeping their current investments whole. And funding newer companies has been tougher. The diligence cycles are longer. The question and answer periods are tighter, stronger. But as much as this feels like a very challenging year, and it is 2022 relative to 2021, it's still a pretty good year when you go back in terms of the history of funding. If you were to take a 3-year rolling average of 2020, 2021, and 2022, you would still see an upward trajectory in terms of money raised and money deployed. And that would be true over 3 years, 5 years, and 10 years. In fact, we are funding this year 3 times what we did 10 years ago. So it's still relatively healthy. But if your horizon is last year to this year, it looks like we've fallen off a cliff because funding is down 30, 40, 50%, whether you look at it quarter over quarter or year over year or U.S. versus globally.
So Jay, are you seeing the same things that Greg's seeing?
Yeah, it's interesting from the bank's perspective. A good reflection of the capital markets is really loan demand, and that really depends on the size of company you are and the industry that you're in. So what we're seeing, for instance, in the kind of large corporate space is loan demand continues to be fairly strong. If you're talking to a manufacturer or a wholesaler, they're still looking to expand. If they're looking at a piece of equipment or a piece of commercial real estate and they see interest rates rising, it's actually a catalyst to go lock that in and actually buy that piece of equipment or buy that piece of real estate. Everybody is concerned about a recession. Everybody is facing supply chain issues. Everybody is dealing with inflation as well. But in the large corporate middle market space, we're still seeing loan demand fairly strong. Now, in the small to mid-sized businesses, I'd say loan demand is softening. And I think business confidence is being more affected by the things that I just mentioned. I think uncertainty is a lot higher in those spaces. So I think it really, again, depends on the size of company you are and the industry that you're in. In terms of bank appetite, we have not changed appetite, in the last several years. Our credit box has not tightened. So from that standpoint, I'd still say that has remained relatively unchanged.
So Ted, you work with a lot of smaller companies. So what's your perspective? What do you see happening in the capital markets right now?
So big picture, there's a lot of money in the market, but it's gotten very conservative. And people ask a lot more questions, as we were just talking about. I think the interest in investing in early stage, seed stage, A round are there. The hurdles are just higher than they have been. Some of the place where indigestion is setting in is further along, right? IPO market's down. The bigger rounds are a lot tougher to get into today. But in my perspective, if you're raising early stage money and you're looking for a few $1 million, it's available. You just have to work hard at it. Now, having said that, I think the other thing that's important to know is if you're raising money today, there's a chance you're to have more money tomorrow, and this cycle just needs to continue, right? Networking, building your relationships, keeping people you talk to up to date. I've been coaching 4 of the Baltimore Techstars companies this year, and Techstars has this software package that they allow people to use that's like a 2-page update. What's up, what's going on, what are we doing, what are we looking for, what have we accomplished? And the really good entrepreneurs send that out on a monthly or bi-monthly basis. You want to just keep your name in front of the people that think highly of you. And again, if you get a meeting with an investor, that's a really good sign. But just remember, once you get that meeting, the investors are looking for reasons to say no. You already have a yes, but they're looking for reasons to disqualify you. So to be able to keep current, keep people that are interested in you up to date, and early stage, just do your homework. Because this is a real life example from one of the portfolio companies that I'm invested in. They got into a jam this summer. They needed cash. They needed $5 million, and the terms were so onerous. The money was there, but there wasn't money available to close in 60 days, and all the previous investors got pounded down to common stock. And the new people that were in were willing to let the existing investors back in with new money. But if you didn't invest in the new money, the chances of you getting something of significance out of that common stock that they pounded you down into is not very strong.
So a couple of interesting themes there. So, Greg, you mentioned that if you look back with a relatively short-term view, it looks like we've fallen off a cliff. Elaine, you mentioned valuations and some of the pressure. And Ted, you talked about existing current investors getting pounded down in the new round. On a recent Capital M podcast, we had a down round. A down round, for those of you may not know, is having to raise capital at a valuation that is less than the last time you raised capital. And if you raise capital, say, in the last 18 months, and you didn't raise enough to get you through a couple of years, and you're out raising capital again now, you may be facing a down round, which existing investors don't like. So what about some thoughts about the impact of these short-term changes and what the impact that they'll have on companies raising capital right now? Greg, maybe start with you.
Yeah, so through my networks and my companies, what I'm seeing is some extension rounds. One, you're seeing the tap into of debt. So venture debt is becoming more and more prominent because then you don't have to go price and equity round. You're also seeing short-term extensions, so a bridge round from what may have been pre-seed to seed or C to A or A to B. So it is a dynamic that says just try to get through the year into next year, and hopefully in 3, 4, or 5 quarters, we're in a far different operating environment. And I think we will be, and I think that's the bet for a lot of companies that are coming into this market to raise right now.
Elaine, how much pressure are you seeing on valuation?
So we're seeing it, and we'll see it more as I get my first term sheet and start negotiating on that. But we were pretty reasonable with where we set our cap on our bridge round on the convertible note. We did do an expansion and took the cap up a little bit, but we're easily going to get a valuation that is a step up from that. Where I predict I'm going to have the challenging conversations is with making that determination between, okay, do we take money now at the valuation being presented to us or that we can negotiate versus satisfying the expectations of my current board and founders, which look at, the math that they're doing on where they think the valuation should be and what reality is in this market. So that'll be a challenge.
There's often a conflict there, isn't there?
Yes.
Okay.
So on valuation, I think for this audience, a lot of this really applies, is be really cautious and careful about where you set that valuation. The markets are what they are. There's a lot of jitteriness. There's a lot of people that are nervous about investing and a lot of money on the sidelines. But valuations today aren't the same valuation you could have gotten a year or two ago. And another real life example from a Techstars company that's based in Tampa, they've raised $125,000 and they need millions. So they raised 125. They have no revenue. They have no SBIR grants. They have an idea, and they have one prototype. And I keep working the entrepreneur. He's fast $1 million, $12 million valuation. And it's like, there's no way you're going to get $10 or $12 million valuation. And if you go out and you look poorly by taking that forward, it just hurts you in the future. So be realistic in what the market valuations are and how you're trying to play it and what you're asking for, because it's an old story. You only get one chance to blow it. There goes somebody in your network.
Thank you. So, Jay, talk a little bit about, in times like this where companies are struggling with these decisions and these negotiations, how important is their banking relationship, and what kinds of things are you and Truist doing to help companies navigate these times?
Yeah, I think banking relationship is really important. I also think it's one of the most underrated relationships that businesses have, because like in the company that you just mentioned, right, a lot of the times if you're looking at the bank as the sole debt provider and the bank is telling you, well, call me back when you're profitable, nobody wants to have that conversation. And that's really, if we're being honest with ourselves, the bank financing is the cheapest form of financing, but the rate of return is 1-2%. So that's why it requires a bank to be right 99% of the time. And so sometimes with those early stage companies, if it's purely about financing, it's hard. But there are a lot of other ways a bank can help, whether it's optimizing your cash collection cycle, whether it's protecting your account in today's deposit environment, maximizing your liquidity, all really, really important things that a bank can do. In addition to that, particularly if you're an early stage company, some of the things that, we talk about access to capital, but access to capital in and of itself is just one thing. Access to resources, access to expertise, that's really where we see a gap. And having access to expertise that can help you build that resiliency on your balance sheets, that can help you be more judicious about your expenses, that can have a more consultative conversation with you about how you're diversifying your revenue and your different business lines, and how a bank views that, so that when you are lendable, you're able to take advantage of that opportunity. Those are all the conversations that a banker ought to be having with their clients, particularly in the early stages. But I think all too often, and I think banks are guilty of this. If you look at a company pre-revenue or they're still in the red and they're not lendable, that's where the conversation stops. And I think there's a much more robust conversation that needs to happen at that early stage to help them in order to get to a place where they are lendable, they can take out bank debt.
Great, thank you. So let's bring this home to Baltimore. Ted, just a few minutes ago, you were talking to me about how you made the decision to take your last company, Path Sensors, to Baltimore from Montgomery County, and why you made that decision, and what it meant, and how it benefited you. But let's talk about that from the perspective of capital, accessing capital. What was it like? Is it different? Is it more challenging in Baltimore? Is it easier? What did you experience?
My perspective is, previous biotech company to Path Sensors, we were in Montgomery County, and that's BioCentral for the Mid-Atlantic, and lots more resources, connectivity, people that are there to help you. You come to Baltimore, and Baltimore's Charm City is the nickname, right? And that plays out pretty well here. There's a lot of resources. They're just fewer in all these different buckets that you get to draw from. And in 2010, when we were raising money to stand up Path Sensors, the reason we came here was an entity in Baltimore was really excited about getting a high-tech biomanufacturing company here. They invested in us with the caveat that we had to be here. Montgomery County has very deep pockets, and they'll write you a check out of their economic development fund with stuff Brad Stewart does. But Baltimore is much more of a family, whereas Montgomery County is more typical business. So if you can tie into the network here in Baltimore, there's a lot of folks that can support you, and a lot of the folks are relatively new, right? The Maryland Momentum Fund is 3 years old. Wexford Life Sciences is just starting a fund now. I think they're working on their first investment. Those weren't there 10 or 15 years ago. The Able Foundation has been strong and steady in Baltimore. TEDCO is always a great place for a new company, a new entrepreneur to start. They're pretty flexible, and they have funds that they'll partner with you on the way up. But I think it's really, where do you get the network connectivity that you need? And Baltimore has lots of talent in the way of biotech scientists, engineers, technicians. And when Path Sensors moved here, one of the things I really appreciated was I didn't have a lot of other companies poaching my key people. In Montgomery County, we spent a lot of time recruiting just because somebody was stealing our employees and giving them a raise. So there's the whole environment is here and it's available to Maryland entrepreneurs, but it is really different from Baltimore to Montgomery County, and you just have to recognize that. And and again, it's your network. You need a strong network of people that know you, believe in you, and will introduce you to additional people in the network. That's how this whole thing works.
So, Elaine, you made the same decision, but you came all the way from St. Louis. So talk to us about that decision and the impact that it either has or hasn't had with respect to raising capital.
Yeah, great point. And St. Louis and Baltimore are very similar cities, good, bad, and otherwise. But there is definitely more access to capital, more access to talent, more access to stakeholders in the Mid-Atlantic versus the Midwest. So those were some of the reasons that we chose to move here. But those were really ancillary to our founder expanding his research platform and looking for the right location that would allow him to expand his research, but in a way that allowed him to bring the company along. So when we moved here, UMB, University of Maryland, Baltimore, and Biopark were extremely supportive. The university was innovative and allowed Kalasite to lease space within the research center, within the School of Medicine. We access equipment and personnel through a core lab agreement. So while that's not direct funding, it is much more affordable way to access things that I would otherwise have to spend a lot of money on. And then And very importantly, Maryland Momentum Fund was our first investment when we raised the convertible note bridge round. And not only has Momentum Fund directly invested in us, but they have made connections to other investors. So a little over half of the funding that I've raised since I've been here has been through Momentum Fund. So that has been incredibly important, not only from a funding perspective, but from a networking and just support, expertise, advice, critique on the pitch deck, just access to other services that have really helped us develop. So that's been a huge aspect of our move here. And then, of course, we've got all the non-dilutive funding in the area, which has also been a big.
So do you feel like you've plugged into that Baltimore network that Ted was talking about?
Yeah, I would say absolutely. I continue to meet new people. This event is no different. And we're having deeper conversations with some of the local investors now. One that I was hoping would lead my A round, didn't work out, but that led me to another one that is probably an even better fit. And I'm also, through these connections, even those, some of the investors that I have are not in the immediate Baltimore area. I would say credibility and somewhat of the prestige that we have in the area has helped open doors with other others like in Philadelphia or even up in New York.
Thank you. Greg, what are your thoughts about raising capital from Baltimore?
Well, maybe I can give at least my view of a national perspective and then bring it down to the Mid-Atlantic. We're in a great place, I think. The Mid-Atlantic, depending on how you want to characterize the regions in the country, is it New York or Boston? No. Is it Florida, Texas? No. Is it Northern, Southern California? No. But it is clearly in the top 10 markets and maybe emerging into the top 5 nationally. So this is a great place to be. And I don't so easily draw the distinction between Baltimore and D.C. the way I think others can. But when I just think about the Mid-Atlantic and the resources we have at our disposal and the major institutions that are here, I think this is a great place to be. We're going through a little bit of an adjustment period, like I mentioned earlier, last year to this year, and it may continue. But clearly one of the top 10 places to be, maybe one of the top 5. You're in the right place. It's a technology, innovation, entrepreneurship community driven in large part by the federal government. That's not going away ever. So we should be happy to be here. You're in the right place.
Great. Jay?
Happy to share my perspective on this. So I think what's been interesting in the comments is the operative word is access. And you mentioned opening doors. And I do think, though, in Baltimore City, if you are a Black-owned or women-owned business in a majority-minority community, it is unequivocally harder to get access. And I think that's a real problem that exists in our city and a lot of different cities. And, so part of the work we do, as Truist, in the greater Baltimore area, we deploy around $2 million in kind of our philanthropic giving. $600,000 earlier this week, we went to Baltimore Community Lending, a local CDFI. There are 7 CDFIs in Maryland. Those are community development financial institutions. And 2 of them in Maryland actually do business lending. Baltimore Community Lending is one of them. And they'll lend up to $150,000 today, going up to $350,000 soon when you have shortfalls in collateral, shortfalls in equity. And I think that's such an important resource to get connected to because there are so many businesses, particularly the ones I mentioned in the majority-minority communities, that need that kind of access. They need that kind of resources. And it's not just getting a check. It's getting at the same time, you need organizations like banks, like MTC, like the Emerging Tech Council, like all of these different places to take a very proactive approach in educating entrepreneurs on what is out there so that they can take advantage of it.
Great, thank you. So let's talk about how a company should prepare for the capital markets. And Elaine, I'm going to start with you because you're in the market now. You've gone through that preparation, and I'm sure it's evolving. But if a young entrepreneur came up to you following this panel discussion and said, Elaine, I need to raise capital, how should I prepare? What would you tell them?
A couple of things. First of all, being out there at events like this and attending pitch events, watching other people pitch. There's a ton of resources out there about how do you construct your pitch deck, how do you tell your story so it's relevant to investors. Networking to get the right connections, I think, is huge. Taking advantage of resources at incubators is incredibly helpful and important. We've been very strongly supported by NIH. We have a couple of grants with NIH, and they have programs for their awardees where they will sponsor you to go to pitch events and mentor you on preparing for pitch events. Be prepared to get lots of feedback. And anytime you pitch to someone, you're gonna, you view that feedback as a gift, and the questions that they're asking, if you're constantly getting the same questions, maybe you're not appropriately telling your story and putting that information in your deck. So it takes a lot of time, effort, and energy. You have to be humble. You have to be very open to listening. And just sticking with it.
Yeah, so I'm going to come to Ted and Greg, but slightly different twist on the question. And that is, as investors, what do you expect to see in the way of preparation from a company that's looking to you for investment? And Greg, let's start with you.
So there have been studies of presentations done to venture capital angel groups, and two things come forward from that. When you ask the question, what do investors focus on? Two things from the pitch decks. One, commercial traction. Two is who's on the team. If I were to guide entrepreneurs, founders looking for venture capital, I would focus on really strength of story around those two pieces. If you are pre-revenue, it's a little bit more challenging. But then I would guide toward third-party endorsements and connectivity and sponsorship and this and that. But you've really got to have a strong story to tell around commercial traction and who's on the team. Commercial traction, I think, is pretty self-evident. But in terms of who's on the team, it's not just the founder or co-founders. And there's a lot of evidence that says a single co-founder doesn't raise as well as multiple co-founders. But beyond that, there could be, if you're in science, a scientific advisory board or a strong advisory board that has these connections that can help advocate for the company. So my guide is those two things. Be really strong in telling a story around commercial traction or how you're going to get to it. And then secondly, build your network and represent that. Who is on your team to advocate for you?
I think I pick up on what Greg said with telling your story. It's really, really important to have what people will call elevator pitch. 30 seconds. Something you can talk about very quickly, it flows easily, and it tells your story, all the key points. That is critical. And the other part that goes along with that is showing that you're coachable. There'll be a lot of people that are willing to help you if you're coachable. And especially in the world of science, you deal with people with very high levels of education, PhDs, and some of those folks, they think the world revolves around them. And if somebody's not coachable, people are not going to invest in them. Because, right, it's the technology is interesting, but what it really is the investors are making a decision that you are going to be able to figure this out. And I'll give you up close and personal story. If you've seen ID Me on TV, they're doing the identity verification for Social Security. The company's growing like crazy. They started out as a Groupon company for people in the military. The guy who was the founder of that figured out he needed, the buzzword today is pivot, right? But he pivoted. He found this identity authentication technology, and ID Me is crushing it. But they started out as a coupon printer. So really interesting. But that company got to where they are because the investors that funded them believed in him. They didn't care so much about the technology, and the technology wasn't relevant in the end anyway. And one thing that I've found is a really good resource, and I'd encourage anybody to get one of these, is it's a book called The Art of the Start. A guy by the name of Kawasaki wrote it. It talks about What do you need in a pitch deck? What do you need in a sales deck? How do you approach investors? Very easy read, really good reference material, and that kind of stuff. If you've never done it before, there's an easier way than the school of hard knocks, right? That's why you have coaches, to keep you from driving through all the potholes in the road. And if you can start with a reference book that gets you moving that direction, I think that's a really good use of time.
Thank you. Well, I suspect that we're getting close to the end of our time. So before we open it up for questions, is there anything that we haven't talked about this morning that you were hoping to talk about? And Jay, we'll start with you.
I would just maybe elaborate on some of those comments, because when you're looking for investors, it's one thing. When you're looking for a bank to partner with you, it's another, but it's not all too different. Cash flow obviously is king in the banking business, but we also pay a lot of attention to the management company. And one of the classic mistakes we see is an entrepreneur who went from 0 to 5 million thinking that same strategy can work going from 5 to 20. And a lot of that, talk about great books. One of them is Good to Great by Jim Collins. Do you have the right people on the bus, and are they in the right seat? And sometimes it makes a world of difference to have a CFO, a COO. Sometimes that can help if you have the capacity to bring those people on. I think that can make a huge difference, and something that banks look at very, very closely. So I would just stress that point, to make sure that you've got when you're honest with yourself, quiet with yourself, do you have the right people around you? And is what got you here also the same thing that can get you there? And really being just honest with yourself around that process. And sometimes the answer is yes, but I think just going through the practice of analyzing that is such an important step, and something we often see at the banking side that doesn't always happen. So,
Greg?
Maybe my quick comment is just a call out to the founder entrepreneurs and the empathy I have for them. It's hard to take an idea, build a team, turn nothing into something, with commercial traction, with money coming in, with employees that you can hire. And I would say, even though this operating environment might seem a little bit tougher than usual, great ideas and great companies are founded every single day in every kind of operating environment. So keep pushing and circulate. Just back to the other comment around getting out there and connecting. Circulation is key. Every single week, every single month, just keep circulating.
I love the way you boil it down to one simple phrase. It's hard. Elaine?
I would say don't forget about non-dilutive funding, federal grants, but at the same time, don't spend all of your time, effort, and energy on chasing grants. Grants take a long time to get. The money is lumpy. You get it after you've already expended the resources, and you can't use it for everything. But we've raised over $7.5 million in non-dilutive funding to date. I have another $6.5 million pending that'll be coming in, and that has been really helpful for my investors for demonstrating credibility, because they know that NIH or Department of Defense has reviewed my science and reviewed our proposals and our plans, and that gives them additional confidence.
Thank you.
So I guess the two thoughts that I would leave is, one, you've heard it from, I think, everybody here, is humility. Be humble, especially if it's high-tech stuff. Be humble. There's a lot of people that'll help you. The amount of time I spend working with companies that I don't get paid for is pretty significant. But I'm not going to work with people that I don't like, right? So the humble gets you a long way. And the other part, again, my background is technology. All my companies have been tech. Every day is a selling opportunity. If you're an entrepreneur, you have to sell people on the company if you're raising money. If you're making a product, you have to sell the product to people. The number of technical people that start companies around here is pretty high, but they don't have any experience in sales, marketing, connecting with people. That's really, really important. And one of my partners at Blue has started a new fund, and it's really an interesting model. He will take a cohort of 10 early stage companies, and he's a salesman by training. He'll put these companies through this. It's like a Y Combinator for sales and marketing. He'll put his companies through that, and each company that goes through that, that group will invest $150,000 in them. So you're getting skills, you're getting connectivity, and you're getting money. And the people that are in that group, there's a number of them from Blue. Once we get to know you, you're on a little easier path getting into the queue at Blue to pitch your idea. Doesn't make the screening process any easier, but again, it's all relationships. So everything is about selling and building the network, building the relationships.
Great, thank you. So let's open it for questions. Do we have any questions from the audience? We'll start over here. We need to get you a mic.
Hi, Lisa Dorsey, TEDCO. Just wondering, from looking at investing from the sort of bigger picture, now short term valuations look like they're coming down. Doors are not quite as wide open as they had been. Would you say the sort of time frame for an exit has also compressed? You think of it as being maybe 5, 7, even 10 years before there's any kind of meaningful exit. Has that compressed, and how does that fit into the current sort of scenario of tightening?
So my last company, Pass Sensors, is a biotech. We sold it 2 years ago to a British conglomerate. We hired an investment bank, went through the whole process. It was in the middle of COVID, it's not a good time to be selling a company. Now, just by the by, we started the company after the 2008 financial crisis, which wasn't a great time to be raising money, so we got GM'd on both sides. I think an exit depends on what the exit is looking like. If it's an IPO, big issues there. You better have the cash to last through this next 18 months because the IPO market has really changed dramatically, smaller. If it's a technology, and a lot of what we've been talking about is technology companies, people look to this area as being a breeding ground for technology, translation, commercialization, and if some big publicly traded companies looking for a bolt-on acquisition, that can play pretty well. A local, and this is a long-winded example, but a local company called Paragon, a couple years ago, they put themselves up on the market. They got a deal for $300 million. After a couple months of diligence, the deal fell apart. 6 months later, they took a deal for $1.2 billion. That doesn't happen today, right? So markets are driving this stuff. But if you're looking to be acquired, I think that's a lot different than an IPO. And an IPO and things that far along, it's going to be challenging for the next year and a half or 2 years.
Yeah, I would maybe emphasize and echo the IPO market. So that crossover market from the private markets to the public markets completely dried up. And that is depressing valuation. So you see it in risk on in the public markets. All the high-flying cloud stocks have corrected. That dried up the crossover market, and that started to dry up valuation and financing at the later stage, and it has started to come down to the lower markets. So I think, though, if you're in, for example, med devices, so I'm invested in a company that is looking to exit. Once they get through FDA approval, they're looking for a fast exit in the next year or two. They will probably still be positioned to get that. No change, really, in market dynamic. I'm in a number of other kind of enterprise software cloud stocks, and with that investing horizon being 5 to 7 to 10 years, no change in how they operate, no change at all. If they were trying to IPO this year, they just wouldn't be able to IPO. It'll get pushed out a year or two, but they're still going to get the financing they need because they're a well-positioned company.
I would add one thing that the time frames that we're seeing with investment capital has a downstream effect on future exits by acquisition. The longer it takes you to raise money, the more you have to hold back on stepping on the gas and making technical advances, and then you're not getting to the stage where you can get acquired.
So Jeff Cherry, the microphone is here.
Hi, guys. Thanks for this. Jeff Cherry, I run a Conscious Venture Lab and a Conscious Venture Fund. We are an accelerator and a venture fund based here in Baltimore, focused on investing in minority, underrepresented founders, anyone that other people are ignoring for all the wrong reasons. I think it's a two-part question, first for Jay and then for everybody else, because I think part of the problem with raising capital is, in Baltimore, we don't have very many large, mostly pre-seed, seed, and Series A funds, right? There's a gap in the market. So my first question for you, Jay, is are you guys invested in any funds? And can you tell us about, if you are, how you guys think about that? And then for the rest of the group, it would be, how do we get LP money off the sidelines, right? Because there's a lot of money locked up that's just not getting into funds, right? So if you're going out and trying to raise $3, $5, $10 million, the options in Baltimore are limited because of that. We're in the process of raising a fund. I had a $700 million hedge fund. I remember essentially our second fund, and an African American was still looked at as a rookie. That's a problem. But just how do we get more money off the sidelines?
Yeah, I'm happy to start. And so, one, after this, I should connect you to Chris Sear, someone who works within Truist that specializes only in SBICs and what that looks like and the funds that we're invested in there. So that's kind of handled centrally out of Charlotte, but happy to connect you to that. The other thing that we have is not only funds, but we invest in companies. So we have it's part of Truist. It's called Truist Ventures. And so we have our own VC firm within house. Generally, the companies that we look to invest in have some sort of applicability with financial services. So for instance, we just invested in a company that helps gamify financial literacy. And so that's something that we're very actively involved in. And then the final thing that, again, we can connect offline on is within our wealth management team, we have a private equity group that's starting to invest in different funds as well, and something that you might be interested in too.
So Minnesota, with where I invest, at least partially, they have a couple of interesting things they do. So here in Maryland, we have the life sciences biotech tax credit. In Minnesota, that is extended to all technology-based startups. So I would love to see legislatively more expansive investment tax credit. But Jeff, to your other question, I think there is a dearth of first check companies in this region, especially given the size and strength of the region. And I don't know if that is venture capital or private equity or philanthropic or government. But again, back in Minnesota, there's a company called Groove Capital, and I shouldn't really PR for them. But they are a designated first check company, and they're writing $50,000 checks, a lot of them, to a number of startups just to get them moving. I'd love to see that take hold here.
Yeah, I guess the thought I have on money on the sidelines is, again, it's getting access to the people, right? At Blue, we have 70-some partners in the group, and we have about 80 investments since Blue started in 2010. A lot of those folks will invest individually in companies that they find of interest, right? So it's a matter of, again, building the network and being able to connect and being able to sell what you have. I think that some of the challenge is just this whole idea, and I'll just speak for my philosophy, is I get a lot of people that ask me to invest in their company, but 98, 99% of all these companies that are out there starting up aren't successful. There might be 1 out of 100 that's that unicorn. That could, ID Me would be a good example of it. But there's so many of them that don't pass muster. And at Blue, we have an investment committee that goes through all these companies. We'll see a couple thousand decks come in a year, and we have 80-some investments over 12 years. So the funnel is really tight. And the part that you need to do, all of us need to do, is to be able to connect with people. People try to connect with me, and it's like, I like you, I like your technology, but if I invest in you, that's money that's going into one. If I do it through a fund, now my money can be spread across 10 companies or 20 companies or 100 companies, which just improves the stats for me being able to have one unicorn in that portfolio.
And Jeff, I want to add a little bit as well. So So I'm an old sales executive, so my opinion might be a little bit biased when it comes to how do we get more LPs to put their money forward. I think we need to tell the story. We need to tell the story really well. We need to be persuasive as a group, not just as individuals. I talk to a lot of investors around the country, around the world, and there's a couple of questions that I always ask, and one of those questions is, when you invest in a company and you ask them to move out of the location where they currently reside, why do you do that? And they tell me inevitably the answer is, because I want that company that I've just made a significant investment in to be in a location where I know they've got the resources and the support and the things that they need to succeed. And that tells me that we're not telling our story as well as we should be, because those things exist here, and we need to be more persuasive. We need to really tell that story. So that's the view of an old sales executive.
Say something about that. I had a conversation with some bank you guys all know, and they decided not to invest in our fund. One of the reasons they said, there are a lot of good reasons. One of the reasons they said that the Baltimore region, geographically, they were looking nationwide, didn't compel them like some other regions where they thought where the activity was happening. So I think that tells the story.
Yeah, great. Thank you for that. Any other questions? So I'm going to conclude with one question of my own. Just quick 20-second response. We've talked about the looking back, the near term, what's happened. What's your prediction for the future? Where does it go from here? What are we looking at in the next 3 to 5 years in the capital markets? Ted, start with you.
Everybody has their own crystal ball here, right? I'm really bullish, right? I think as an entrepreneur, you have to be a glass half full type of person. I think the next 18 to 24 months is going to be a real problem. All that money got poured in, probably in too much money, and now it's started to all be wrung out of the market, and it's started to be painful. But I think if you can get through that, 3 years from now, 4 years from now, there's just such a vibrant ecosystem in this area. And if you just compare the United States and this investor ecosystem to the rest of the world, you don't find this type of thing very often, but you certainly don't find groups like Blue Venture Investors in Japan, in China, in Europe. The story people try to write, it's hard to write, and you can't, you know it when you see it, and that's sort of what you have in the United States, and I think that's what you see in Maryland between Baltimore and Montgomery County for the life sciences, which I'm a big part of. But I'm really bullish. I think you get in now, you invest in some good companies at really good valuations, they get through to the other side, and there's going to be a lot of really good stuff coming back.
Yeah, I think building on what Ted said, I think from our own experience, it's taken longer for our capital raise than we had anticipated. That forces us to just be much more careful with what we're funding, much more diligent with our resources and staffing, and really focusing on de-risking our technology. So generating data that shows that we are addressing the things that could potentially limit our growth going forward, and I think we're going to emerge stronger and be more investable at the other side.
So there is a record amount of money sitting on the sidelines today, $230 billion US sitting on the sidelines waiting to be invested. It hasn't been invested this year and in a little bit of into 2020 or 2021. That money has to come off the sidelines. Globally, it's $500 billion. So the question is, or the challenge we have is, so organizations that are raising funds are getting access to the funds, but they're not deploying it. So why are they not deploying it? And two things really this year. You have geopolitical tensions around Russia and Ukraine, and then you have inflation. And when those two issues, in my opinion, start to temper, you'll see some of the money come off the sidelines, and then it will start accelerating once there is more clarity for the markets. And one of the things we have to keep in mind in public markets and private markets, the markets look for clarity and they look 6 months out. And you don't have a lot of that right now. But when that starts to become more clear, you'll see the money come off the sidelines. And it has to come off the sidelines or it gets returned to the funders. And the other interesting dynamic in today's world is, especially over the last few years where you've seen this acceleration into all things digital transformation, new players have come into funding these markets. Philanthropic organizations, hedge funds, mutual funds, that's where all this new money's coming in. So it will come off the sidelines, whether it's next year or the year after, I don't know, but it is coming.
And to that point, I read something yesterday that showed 20 years ago there were 800 private equity firms in the United States. Today there are over 10,000. It just kind of shows the explosiveness of that growth and what that means. Kind of from a banking standpoint and economic standpoint, you know, what's been really interesting is that we haven't seen demand tamper at all. I think we will see that. I do think we are going to head into a recession as just defined as 2 consecutive quarters of negative GDP growth. But I don't think it's going to be anything like, 91, 2000, 2008. It's not going to be anything close to that. I think banks, by the way, are in a significantly stronger position than they ever have been in. I think the balance sheet of banks, in terms of industry-wide, is exceptionally strong. You've got these fortress balance sheets all over the place. Capital reserve ratios continue to be really high. So I think banks, the ability to withstand the next couple of years where we are going to have more economic headwinds is really important. But I think banks are going to play a big role in creating the stability that we're going to need.
So I just want to thank everybody for joining us. I think this has been a great conversation. If you're looking for more information, I would point you to the Capital M podcast, where we talk about access to capital and the challenges and opportunities that we face here in Maryland and here in Baltimore. So, ladies and gentlemen, Jay Taracchia, Greg Miller, Elaine Hayes, Ted Olson, thank you so much for your time this morning. Really appreciate it.